You will learn accounting methods that will help you understand the budget setting process. You will discover how to calculate your department's budget to meet your part of the organization's objectives. You will also learn how to set up monitoring systems to compare actuals to forecasts and eliminate surprises. What does finance have to do with managers in an organization? Companies today are asking their managers to be responsible to some part in the financial performance of the business and are measuring this aspect in managers' evaluations. Controlling costs, monitoring budget expenditures, setting budgets, and reporting on budget issues has become one of the major functions of management personnel. A company measures a leader's worth by his or her ability to count and control costs. Organizations are attempting to train their management personnel to set, monitor, and control budgets by conducting the responsibilities of their position as if they were operating their own business. This may be new to some managers, but the professional leader must be sufficiently versed in financial matters to understand it. Four basic financial objectives of a business. 1. Efficiency. Efficiency is the productivity of assets, meaning the relationship between profit generated and assets employed. A business must ensure that its assets are used effectively and that they produce a return. When shareholders see high profits, they know that the assets of the business are working hard. Prosperity. This means growth in all segments of a business: sales, profit levels, dividends to shareholders, fixed assets, equity, and working capital. Liquidity. This is the firm's ability to meet its short-term financial commitments. If a business increases its sales, it will increase inventory, accounts receivable, and cash reserves required to pay suppliers and creditors. And finally, 4. Stability. This deals with the current and long-term financial structure of a business. Financial managers must ensure that there is a balance between the funds provided by the creditors and those provided by the shareholders. Consider this: a business with a high debt ratio risks not being able to meet its short and long-term debts, especially if there is a slowdown in business caused by unfavorable economic conditions. As an example, the meltdown in high tech in 2001. The debt ratio was way too high, and when called in, many businesses collapsed into bankruptcy. Definition of terms. Much of the fear of any topic is unfamiliarity with the meaning of certain terms. Finance is rife with such heartstoppers. Have a look at the following list of terms and their meanings to get the old ticker going again. Assets. These are resources that a business owns to produce goods and provide services. These are tangible assets such as cash, inventory, land and buildings, and intangible assets such as patents and goodwill. Liabilities. Amounts that a business owes to suppliers and to other creditors for financing purposes. This includes accounts payable, mortgages, bonds, and bank loans. Capital or equity. The funds provided in a business by its shareholders. On the balance sheet, owner's equity equals total assets minus liabilities. Balance sheet. This is a financial statement that indicates what a business owns and how those assets are financed in the form of debt and ownership interests. Income statement. A summary of revenues and expenses for a specific period of time. It is also called the profit and loss statement. Budget. A quantitative expression of a contemplated plan of action against which future performance will be gauged. Depreciation. The loss in value of fixed assets due to wear and tear and/or becoming obsolete. It is an accounting expense made with the invention of apportioning the cost of the asset over its useful life. If you have an understanding of these basic concepts, you will be able to know what you are talking about. Basic finance functions. We have seen what the financial objectives of the business are. Now look at what the basic functions of finance are in an organization. Planning. This includes short and long-range profit plans, such as preparation of fund flow forecasts to decide the inflow and outflow of funds. Budgeting. This is the coordination of operating budgets. In large companies, this will mean that many departments must prepare their budget submissions. Usually the finance department will set the guidelines for preparation for each department, monitor their preparation, and consolidate all of them into a master company-wide budget. Control. Financial managers set the standards during preparation of financial plans and budgets, and for evaluating business operations against budgets. Custodians of cash. The financial managers ensure that there are sufficient liquid resources available to meet ongoing business commitments. Cash, accounts receivable, inventory, and marketable securities are all short-term assets. Provision of funds consists of securing funds required to purchase assets. Funds are raised from two sources. First, external short-term loans from banks and long-term funds from bond issues and common or preferred shares. And internal funds generated from operations. Protection of funds includes internal controls and internal auditing and insurance against loss or damage to property and personnel. Tax management consists of planning, tax returns, business decisions, and government examination. Investor relations. The organization's management personnel must cultivate relations with present and future investors. Management information systems. Electronic information related to costs, prices, preparation, or consolidation of different types of budgets, financial statements and reports, variance reports, etc. Accounting methods. To further confuse us, accountants talk about basic accounting methods. To keep it simple, we will discuss two at this time: the cash method and the accrual method of accounting. Cash method. This method of accounting is the simplest of the two. It consists of keeping a record of cash receipts from the sale and disbursements of expenses. In this case, the business recognizes revenue when cash or its equivalent is received, regardless of when goods or services are delivered. Expenses are treated the same way. Expenses are deducted from revenues, and the excess is the net income or loss. This system is usually used by small businesses that do business on a cash basis. Secondly then, there's the accrual method. This method disregards the receipt and disbursement of cash. It records revenue when goods are sold or services rendered, and the related expenses are tied to revenues. For example, if a business makes a sale on a cash or credit basis, it assumes that revenue and expenses have incurred. Although a sale may be made on a credit basis and cash has not been received, or goods may have been purchased from suppliers on credit and payment not made, the revenue and expenses are recorded in the applicable accounts. The most important accounts that differentiate the cash basis method from the accrual basis method are accounts receivable and accounts payable. Costs. This is an important concept in finance since most conversations boil down to how much is it going to cost. Cost can be broken down into two types of costs: direct and indirect. Direct cost, sometimes called variable costs. These costs are directly related to a specific activity, product, program, or projects. It is a cost that could be avoided if an activity were eliminated, for example salaries, fringe benefits, raw materials, etc. Indirect cost, sometimes called fixed costs. They are not associated with a particular activity, product, program, or project. Overhead, like hydro, heat, water, and insurance, are indirect costs. Overhead costs are usually apportioned over a range of activities, and if an activity is canceled, these costs are absorbed by other activities. Please view the Examples of Cost Centers handout from this module. This is a very simple example of how an organization can allocate its fixed costs to different departments. Financial statements. Financial statements are basically tools that show a business position or performance on a certain date or over a period of time. Again, the mere mention of their name is enough to strike fear into our hearts. Two most often mentioned ones are the balance sheet and the income statement. Let's demystify these by looking at a simple example of each. As mentioned, a balance sheet is a financial statement that indicates what a business owns and how those assets are financed in the form of debt or ownership interest. This simple example gives you an idea of what this statement contains. First are listed the assets of the business. These are broken down into current and fixed assets. Current assets include cash, accounts receivable, and inventory for total current assets. Fixed assets may include land, buildings, furniture, and fixtures. These are added to give total assets. On the other hand, we have current liabilities, which includes accounts payable or amounts to creditors and notes payable, or short-term debt borrowed to finance operations. We also have long-term debt. The total of assets minus liabilities equals the equity of the owners or capital. For the following, please refer to the income statement handout from this module. As stated, the income statement, also known as the profit and loss statement, is a summary of revenues or expenses for a specific period. The income statement is for the period of 1 year ending December 31st, 2001. On the revenue side, or what has come in, accrued, is sales. From this, we subtract the cost of these goods sold, which gives us the gross margin or profit. Below this, we have the expenses, or what went out to make these sales. These include the cost of utilities, hydro, gas, water, etc., salaries paid to employees, advertising costs, insurance, legal and accounting fees, depreciation on buildings, equipment and fixtures, vehicles, and finally, the ever-present miscellaneous. This is totaled and subtracted from the gross margin to give us net income, BFT, before taxes. Taxes are then subtracted to give us the net income after taxes. This is the profit made by company XYZ for the period year ending December 31st, 2001. Budgeting. Budgeting is the process by which management allocates company resources, evaluates the financial outcome of its decisions, and establishes the financial and operational profile against which future results will be measured. Closer to home, take the example of how we budget at home. If you keep track and calculate the cost of running your home by totaling the cost of mortgage or rent, utilities, insurance, taxes, repairs, etc., you are already budgeting. Why budget? Budgeting is a tool that will aid in 1. Communication. It aids in vertical and horizontal communication. Coordination. Helps to coordinate tasks performed by various departments. 3. Decision making. Used in deciding what activities and to what extent they are carried out. 4. Monitoring. Once standards are set, the activity can be monitored against accomplishment of goals. Next, performance. Evaluation of managers' performance can be accomplished against budgeted activity. Survey budget. For the following, please refer to the survey budget example found in the handouts for this module. This is a survey that Human Resources wishes to carry out to get their opinions of the employees. Here's an explanation. This deals with the cost to carry out a survey. Let's say an employee survey to assess the attitude towards the company. The first item is the fixed costs. Overhead has been allocated to this endeavor of $1,000. Salaries of employees to carry this out are $3,000. Fringe benefits to employees are $600. Postage to send out this survey is $500. Phone costs to follow up and monitor responses are $300, and the printing of the survey is $2,300. The total cost is $7,700. Monitoring. Budgeting involves the setting of standards, financial and non-financial performance indicators that are key to management. When resources are allocated to a manager, there should be a precise set of standards accompanying them, which state how efficiently resources should be deployed. Standards facilitate reporting, and a well-designed reporting system helps management keep up to date on issues like Are we on target? And if not, why? Who is responsible for unfavorable profit performances? What impact will an increase in material or labor costs have on profits? If we are to maintain or increase profits, should certain costs be trimmed? Should prices be changed? What are the causes of variance in each responsibility center? Performance evaluation. The budget is one of the most important instruments in the evaluation of a manager's performance. With fixed budgets allocated to them, managers can be evaluated from two perspectives: as planners or decision makers, and as implementers and doers. Budgeted versus actual. In order to monitor the process, the actual costs were recorded in the actual column and variances were shown. In the actual column, fixed costs were $1,000, $0 as the variance. Salaries were $3,000, $0 as the variance. Fringe benefits, $600 with $0 variance. Postage, $800 with a $300 variance over budget. Phone, $100 with a $200 variance under budget. And printing as $2,700 with a $400 variance under budget. Total is $500 over budget. The boss goes ballistic. Now you must explain why this happened. Explanation of why the variances occurred. Postage, $300 under. Got a cheaper rate on bulk mailing or sent lower class and it cost less. Phone, $200 over. Had to phone people to get all the responses back. Printing, $400 over estimated cost of setting up and printing more forms. Had to do an extra printing because of errors in the first batch. Rules for budgeting. 1. Pinpoint authority. Make sure that reporting responsibilities are clear and managerial authority is well defined. 2. Integrate all planning activities. To be effective, budgeting must be linked in a systematic way to other planning activities, such as setting goals, identifying corporate priorities and strategies, and establishing guidelines and management objectives. 3. Insist on sufficient and accurate information. Information is essential to decision-making, the prime purpose of budgeting. All budget aspects, from cost-benefit analysis to the establishment of performance standards, depend on the availability of current and accurate data. Encourage participation. Essentially, accountability is measuring achievement against goals. Participation in goal setting encourages enthusiastic effort and a realistic attitude. Few people like to be fully responsible for hitting and missing someone else's targets. 5. Link budgeting to monitoring. Budgeting is meaningless if it is not linked to monitoring. What is the point of spending endless hours formulating plans and budgets if management does not follow up by comparing the actual performance with the preset standards? 6. Tailor budgeting to the organization's needs. How information is displayed, consolidated, and reviewed is a highly individual matter. A system that works well for one organization will not necessarily produce the same results in another. Because management style, information needs, and corporate structures differ, each must create a budgeting system that meets its own special requirements. 7. Communicate budget guidelines. To ensure economy of time and effort, remove confusion in an organization and prevent the budgeting system from faltering. It is essential to establish and communicate premises, guidelines, and assumptions, for example, of asking for increase if guidelines is to decrease or stay the same. 8. Relate costs to benefits. It is essential to appraise every unit in terms of its contribution to the organization, the benefits expected from the services it provides, and the funds it needs to perform its tasks. 9. Establish standards for all units. One reason for preparing budgets is to make sure resources are spent efficiently and effectively. To determine this, it is important to establish performance standards. Although it may be rather easy to establish performance standards at the production level, it is harder with overhead units, for example, administration, research groups, or accounting operations. Nevertheless, every effort should be made to set performance goals. Finally, 10. Be flexible. Managers should be able to respond easily to changing circumstances. On the manufacturing side, the budget levels change with the level of production. Managers responsible for production operations will clearly not be limited to their budget ceilings if sales levels are exceeded by 10 or 20%. They will respond to marketing needs. With overhead units, however, because of the absence of engineering standards, budgets often become permanently fixed. Yet it is only common sense that, during the operating year, managers responsible for overhead units should be allowed to increase or reduce their activities and, in turn, their budgets to meet new requests or priorities. How to avoid budgeting pitfalls. It is one thing to put a budgeting system in place, but to maintain it as a purposeful management instrument is another. By following these 4 simple rules, many budgeting problems will be avoided. 1. Keep paperwork to a reasonable level. Paper is one of the most destructive elements in any management concept. If managers get entangled in procedures and waste their time filling out pointless reports and compiling endless columns of numbers, the result will be a budgeting system that is being served by managers rather than one that is helping them make better decisions. Keep budgeting subservient to goal setting. Budgeting is not an end in itself. It is a way of allocating resources as stipulated by the firm's objectives, goals, intentions, and priorities. In other words, budgeting is essentially a tool to help management determine how to best deploy its resources in a way that will meet its stated goals. Don't take past activities for granted. 3. Goals, objectives, and priorities change from year to year, and this means that each firm should have enough budgeting flexibility to adapt to current priorities and demands, regardless of the way things were done in the past. Every year, therefore, managers should re-justify their budgets in terms of how much they need and how they are going to spend their dollars. Make budgeting a top management practice. Budgeting is the responsibility of every manager in an organization. All must totally be involved. If top management abdicates its budgeting responsibilities, this will have many adverse effects on the organization. In particular, subordinate managers will lose interest, and budgeting will be, as it is in many organizations, simply a support staff exercise. Conversely, with proper budgeting and firm commitment by all levels of management, managerial work becomes more meaningful and the organization becomes a more productive entity. Please take some time to work through exercise 1, found in your handouts for this module. Cost-benefit analysis. When asking senior management for approval and the funds to carry out a project, or for an increase in operating budget, it will be necessary to show the benefits that will accrue to the organization as a result of the proposed project or increase. In order for senior management to make the decision, they must clearly see the benefits outweigh the costs. As you learned in budget setting, the costs can be presented. The other side of the equation is accomplished through the benefit analysis. These benefits will be financial as well as non-financial. Financial benefits include person per hour savings, a move into new markets, or the introduction of new products, increased sales, reduced downtime, and increased productivity, greater accuracy and quality improvements. New technology, machinery, and methods accrue such benefits to the organization. Upgrading software or hardware can save money and increase productivity. Non-financial rewards may be increased, such as an improved public image, improved employee morale, or it fills needs not necessarily being addressed. Here's an example. At a major airline, an employee punctured the fuselage of an airplane while loading it with a forklift, making it inoperable for some days at a cost of $50,000 per day in lost revenues. On further investigation, it was decided that little training had been given to operators. The benefit of training would include less downtime and more revenues, a sped-up process of loading cargo, and increased morale of employees. please take some time to work through exercise 2, found in your handouts for this module.